Hey everyone, welcome back to Corporate Decoder. Today, Bridgford Foods Corporation just filed their quarterly report, and I'm seeing one big red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is facing some serious financial headwinds, and their liquidity is what we need to watch closest. So we are looking at Bridgford Foods Corporation's latest quarterly report, a Form 10Q. These reports give us a snapshot of how a company is doing financially over a 3-month period. And for Bridgford, the period ended the 17th of April 2026. Let's dive straight into the numbers, starting with their balance sheet. Think of this as a company's financial snapshot at a specific moment. As of the 17th of April 2026, the company had total assets of about $145 million. Sounds like a decent amount, right? But when we look at how much they owe, their total liabilities are around $35 million. A key area to watch is their short-term debts or current liabilities. These are the bills that are due within a year. Right now, they are over $26 million. That is a pretty big chunk when you consider their available cash. And speaking of cash, as of the 17th of April 2026, Bridgford Foods had only $830,000 in cash and cash equivalents. That's a very small amount compared to their short-term debts. They also have a significant amount tied up in accounts receivable, which is money owed to them by customers. That is over $21 million, but they've set aside nearly $2.6 million for potential uncollectible amounts or promotional deals that might not pay off. Inventories are sitting at a hefty $38 million. This is all the stuff they have ready to sell. While it's good to have stock, a large inventory can also mean money is tied up that could be used elsewhere, especially when cash is tight. Now let's look at how they performed in terms of making money, or in this case, losing it. This is their statement of operations. For the 12 weeks ending the 17th of April 2026, net sales were about $50 million. This is slightly down from the same period last year. But here is the kicker. They reported a net loss of almost $5 million for that same short 3-month period. Looking longer term for the 24 weeks ending the 17th of April 2026, the net loss widened to over $5.7 million over the same 24-week period last year. The loss was about $5 million. So the losses are getting bigger. This net loss translates to a loss per S hair. For the recent 12-week period, it was a loss of 54 cents per S hair. And for the 24-week period, it was a loss of 64 cents per S hair. Shareholders' equity is essentially what is left for the owners after all debts are paid. It represents the book value of the company. Their retained earnings, which is the accumulated profit or loss over time, shows a significant negative balance if you look at the accumulated other comprehensive loss. Their retained earnings sit at about $100 million as of the 17th of April 2026, but this is offset by other factors that impact the overall equity. This is one of the most critical statements, showing where the company's cash is coming from and where it is going. For the 24 weeks ending the 17th of April 2026, Bridgford Foods used a net of $1.8 million in cash from its operations. This means their core business is not generating enough cash to cover its expenses. This is a major red flag. Investing activities like buying or selling property and equipment also used up cash, about $438,000. Financing activities like borrowing money or repaying debt brought in about $2.2 million. This is how they are trying to cover the cash shortfall from operations. It shows they are relying on borrowing to keep things running. This section really spells out the company's cash situation. They admit they have incurred recurring losses and generated negative cash flows from operations. They also state they have limited borrowing capacity left under their credit line. This is a direct statement about their liquidity concerns. They have a revolving credit facility with Wells Fargo, meaning they can borrow and repay money up to a certain limit. As of the 17th of April 2026, they had borrowed $3.25 million under this facility, with about $4.25 million still available. But they also mentioned they are in violation of some of the loan covenants, which their bank has waived for now. This is a risky position to be in. Banks can change their minds. These loan covenants are like rules set by the bank. Bridgford Foods was violating 2 of them, the net income covenant and the quick ratio covenant. The quick ratio is a measure of how easily a company can pay its short-term debts. These violations mean they are not meeting the financial health standards the bank expects. While the bank waived these violations, it highlights their precarious financial state. Looking at their major customers, Walmart and Dollar General are significant. Walmart, for example, accounted for almost 29% of their sales in the recent 12-week period. While having big customers can be good, it also means the company is heavily reliant on them. If one of these giants decides to shift their business, it could have a huge impact. Bridgford operates in 2 main segments, frozen food products and snack food products. The frozen food products segment saw its sales decrease slightly. This segment deals with things like biscuits and bread dough. The snack food products segment, which includes jerky and meat snacks, actually saw a small increase in net sales for the 24-week period. This segment is performing a bit better, but is struggling with higher meat commodity costs, which eats into their profits. Across the board, their selling, general, and administrative expenses have increased. This includes things like repairs, insurance, and healthcare costs. While some of these are necessary, they add to the overall cost of doing business. The cost of making their products has also gone up, particularly for the snack food segment due to higher meat commodity costs. This is a constant battle for food companies trying to keep production costs down while selling prices are constrained by the market. Here they outline the risks they face. A big one is the fluctuation in commodity prices. They buy a lot of pork, beef, and flour, and their prices can swing wildly based on everything from weather to global politics. They mention that new tariffs or trade restrictions could also increase their costs. They also point out the struggle to pass on cost increases to customers. If their ingredient costs go up, they can't always raise prices fast enough to match, which squeezes their profit margins. This is a classic problem for companies in the packaged goods space. So, what is my take on Bridgford Foods Corporation? This company is in a tough spot. They are losing money consistently. Their cash reserves are very low and they are relying on borrowed money to stay afloat. The fact that they have violated loan covenants, even if waived, shows financial strain, while they are trying to improve things by increasing prices and cutting costs. The rising cost of ingredients and the pressure from major retailers like Walmart create a challenging environment. Their reliance on borrowing and the tight cash situation are the biggest risks I see right now. What I am actually looking for is a clear path to profitability and sustained positive cash flow. And right now, that remains uncertain. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description.